Imagine waking up one morning and realizing that everything you've invested is gone. Not because of hackers, not because the market crashed, but because of one bad decision. Over the past 15 years, cryptocurrency has created countless millionaires. But behind every success story are millions of people who lost everything, sometimes because of a single mistake. One man accidentally threw away a hard drive containing billions of dollars worth of Bitcoin. Millions trusted a project that was later exposed as one of the biggest Ponzi schemes in crypto history. An entire $40 billion ecosystem collapsed in just a few days. And even one of the world's largest crypto exchanges fell apart in less than a week. These aren't just stories about money. They're stories about greed, overconfidence, and mistakes that continue to repeat in every market cycle. These are 5 of the biggest crypto losses in history and the lessons they left behind. If there's one person the crypto world will never forget, it's James Howells. Back in 2009, when Bitcoin was worth almost nothing, James mined around 8,000 BTC and stored the private key on a single hard drive. 4 years later, while cleaning his house, he accidentally threw that drive away. By the time he realized his mistake, it was already buried in a landfill in Wales. For more than a decade, James tried everything to recover it. He proposed using robots, AI, and advanced scanning technology, but every request was rejected. At today's prices, the Bitcoin on that drive would be worth hundreds of millions of dollars. And at its peak, even more. James wasn't hacked. He wasn't scammed. He simply made one mistake. He never backed up his private key. In crypto, losing your private key often means losing your money forever. If James Howells lost his fortune because of one mistake, millions of others lost theirs because they believed making money could be effortless. In 2017, BitConnect became one of the biggest names in crypto. The company promised an automated trading bot that could generate around 1% daily returns with almost no risk. Thousands of investors rushed in. Conferences were packed, social media was filled with success stories, and the BitConnect token kept climbing. But there was one problem. The trading bot never existed. Investigators later concluded that BitConnect was nothing more than a Ponzi scheme. Money from new investors was used to pay earlier ones, while generous referral rewards encouraged even more people to join. When new money stopped flowing in, the system collapsed. The token lost almost all of its value, wiping out roughly $2.4 billion in investor wealth. The lesson is simple. If an investment promises extraordinary returns but can't clearly explain where those profits come from, the biggest risk is usually the promise itself. By 2022, crypto had grown into a trillion-dollar industry. One of its biggest success stories was Terra. The ecosystem was built around 2 tokens: UST, a stablecoin designed to stay at $1, and Luna, the token responsible for keeping that price stable. Terra attracted billions of dollars through the Anchor protocol, which offered nearly 20% annual returns on UST deposits. For a while, everything seemed to work perfectly. But when investors began losing confidence and rushed to sell UST, the system entered a deadly spiral. The more Luna was created to defend UST, the faster Luna's price collapsed, and confidence disappeared even faster. Within days, Luna lost almost all of its value, while UST never recovered its $1 peg. Around $40 billion in market value vanished in less than a week. The collapse of Terra triggered a chain reaction across the crypto industry, pushing several major companies into bankruptcy. It proved one important lesson: even the smartest financial system cannot survive after people stop believing in it. After Terra collapsed, many investors believed the worst was finally over. But only a few months later, crypto faced an even bigger disaster. It was FTX, one of the world's largest cryptocurrency exchanges. Founded by Sam Bankman-Fried, or SBF, FTX reached a valuation of $32 billion. The company sponsored major sports teams, partnered with celebrities, and was widely seen as one of the most trusted names in crypto. Behind the scenes, however, FTX had secretly used customer deposits to support risky investments made by its sister company, Alameda Research. When that information became public in late 2022, customers rushed to withdraw their funds. FTX didn't have enough money to pay them back. Within days, the exchange filed for bankruptcy, leaving millions of users unable to access their assets. The collapse reminded the entire crypto industry of one famous rule: not your keys, not your coins. Not everyone loses money in crypto because of scams. Sometimes the biggest risk is leverage. Leverage allows traders to control positions much larger than the money they actually own. It can multiply profits, but it also multiplies losses. A relatively small move in the wrong direction can trigger a liquidation and wipe out an entire account. In crypto, moves like that happen almost every day. Many traders start with a few successful trades and slowly increase their leverage from 5 times to 20 or even 100 times. They begin to believe they've mastered the market, but the market only needs one unexpected move. Within minutes, months, or even years of profits can disappear. Every major price swing wipes out hundreds of millions of dollars in leveraged positions. And many of those traders weren't wrong about the overall trend. They simply used too much leverage. Crypto can create incredible wealth, but without proper risk management, it can take everything away just as quickly. These 5 stories happened for very different reasons. One man lost Bitcoin because he misplaced a hard drive. Millions trusted a Ponzi scheme. A $40 billion ecosystem collapsed in days. One of the world's largest crypto exchanges went bankrupt. And countless traders wiped out their own accounts through excessive leverage. But they all had one thing in common. None of them believed it could happen to them. In crypto, making money is difficult. Keeping it is even harder. The most valuable lesson isn't how to get rich, it's how to make sure you don't become the next story.